My guest today is Phil Grant, Managing Partner at Nexia ASR. Hello, Phil.
Hi, Fiona.
Look, there have been a lot of reviews, or there have been some major reviews that should have an impact on the accounting area and business in general in recent times, as well as the budget. And I thought maybe you could give us a bit of a wrap-up about those today. Firstly, we had all that economic stimulus last year. Are there any hidden issues in there for business now that tax time is coming around here?
Look, the biggest thing that came out of that stimulus package really for business, I mean, to the extent that more money was spent, hopefully that's been reflected in clients' bottom line. Not sure whether that's the case or not. Some yes, some no. Obviously the accelerated depreciation write-offs for certain assets, there was various cut-off dates there, but essentially 31 December last year was a cut-off date. So it's important that in compiling information prior to doing your tax returns for the June 2010 financial year, which is fast nearing its end, is that we don't forget that, because for small businesses with a turnover I think of less than $2 million, they have the ability to have a 50% write-off for eligible assets. So that's a straight 50% deduction in addition to excuse me, ordinary depreciation that's able to be claimed on those assets. So
that
shouldn't forget about that.
Keeps money in the company in that financial year, right?
It just becomes an additional tax deduction.
Yeah.
So therefore there'll be less tax to pay, so that obviously conserves some cash flow, and that less money has to get paid out to the taxman. Other than that, look, I don't think there's a huge amount out there. The more recent time we had the Henry tax review. Yep. We've had the federal budget, and we had the Cooper's review, which is another review to do with superannuation. And I think it's fair to say the Henry tax review was a non-event. Mm-hmm. There were a number of recommendations made by Ken Henry in respect to that, of which the government I think took up 3. One of which was
Poor Ken Henry.
It was an absolute waste of time, and obviously there's a political environment we're dealing with there. And the only thing which really, I mean, they're twinkering with their edges, tweeting around the edges there, and it's not. There was nothing. It was a non-event. It really was a non-event, and that's a good thing and a bad thing. The good thing is, less change is probably a good thing. So there's less things to concern ourselves with.
In what way is it bad?
Well. The bad thing, if there's change there's always a problem. But there was nothing really there that was the bad. I mean, there's always the opportunity for the government to do something which could benefit business, and that clearly didn't happen. They said they're going to give some small, the company tax rate was going to go from 30 to 28. Yeah. Really big deal. Yeah. Truthfully, it doesn't really have much of an impact. There's some write-off there for equipment, up to $5,000, I think it was. And there was some, for individual tax returns, $500 write-off. But really,
small bickies.
They're not for businesses who are really the drivers in this economy, who are going to help us recover and move forward. Not much of an impact, in my view. There are a few things. The Cooper's review was quite positive. The Cooper's review reviewed superannuation, and without going to the detail, they've really reinforced self-managed superannuation funds environment, which we have always advocated as being a good environment to help build wealth. Yep. So that was a big tick. They've obviously come out and, commission-based financial planning is out, as we all knew. And look, truthfully, I think everybody knew that was the case. Our financial services business started some 12 months ago, and we knew that was not the model we wanted to pursue, and so we're a fee-for-service business, and that's clearly where the industry's going. So that's a big positive. And
Eureka Report have been lobbying since they started to get rid of those commissions.
Yeah, dreadful, dreadful. So that's change, and that's having an impact on that profession, because a lot of businesses were driven around that. But it's not transparent. So fee-for-service is more transparent, which is really what we're after. There are a number of there's always stuff going on in the tax area. One in particular is in relation to a ruling which came out in relation to a section of the Tax Act called Division 7A, which is loans from companies to shareholders of those companies or associates, and caught up in that is also distributions to companies. Very technical area. Yeah. But suffice to say, there's change there, which has changed the tax officer's stance on their positioning of those distributions, which will have an impact.
Yep.
There is no doubt there will be an impact on that for businesses who utilise that type of structuring. I think a lot of people are just trying to get their heads around that, but I think it's fair to say that it's an adverse impact.
How are those distributions different to retained earnings?
Well, in a trust structure, you don't have retained earnings.
Okay.
So a trust has the choice of either distributing the income or retaining it.
Yep.
Retaining it is usually at a tax rate of 46.5%. So it's
okay. This is why
rate.
you distribute.
So we distribute out
Yep.
to an environment which is more tax effective, but it's obviously a distribution at the discretion of the trustees, and they have to be, distributions that make sense. And often a corporate beneficiary has been used to access a 30% tax rate, but that landscape is changing. So everybody, if they're using those structures, need to talk to their financial advisor or their accountant about what does that mean for them.
Okay, thank you for your time today, Phil.
Pleasure.
I've been speaking with Phil Grant, Managing Partner at Nexia ASR.